folks, it's Doc's Market Minute for Monday, September 14th. We've got the Fed meeting coming up this Thursday, so they're going to release policy and do the press conference to talk about whether or not they're going to raise rates. So between now and Thursday, the market's going to do whatever it's going to do. There's really no point in us going over the charts and forecasting and showing different potentials for things. We know we expect a pretty big movement coming out of this. At some point, we don't know whether the movement's going to start ahead of time or whether it's going to just sit there and hold its breath and wait until Thursday afternoon and then start to really move. So frankly, going over the charts and forecasting things is really just kind of a waste of time. So what I thought I'd do during this week is just go over some very quick and dirty options tricks that we can use to kind of make sure that we're maintaining an edge in this environment. Now today I want to talk to you about volatility. And volatility's got two components. It's got the historic, or what's also called the realized volatility, which is the actual volatility of the price movement. So that is sort of the reality of what's going on. The implied is just that. It's what's forward-looking. It's what's implied going on in the future. And so this is always this battle that option traders are trying to understand and get the right side of to make sure that you have an edge in that, because implied volatility is really about the market maker's way of sort of discounting the future. And of course, the realized is what's going on today. So if we look at this chart, what we have is the red line is the actual realized volatility. And we can see that since the mid part of August there, we've had a big spike in that. And we can also see that the implied volatility also followed suit very quickly after that. In fact, spiking up well above that. So we can see that we're always having this differential between what's implied versus what ends up being the reality or the realized volatility. So of course this is kind of simplistic, but generally what we want to be doing is when implied volatility is high, what it's going to do is it's going to jack up all the premium in the option chains. And that's specifically when we want to be selling or doing more selling than normal. And then when the options implied volatility goes down, so when it's very, very low, this is when we want to be doing more buying of options versus selling, because typically it's like being out into the desert as far as premium is out there, not much to sell. So this means that we can buy options on the cheap and set up some really outstanding reward to risk. So how do you know what's cheap and which is expensive? Well, this is where I use what's called the IV Percentile. So what it does is this indicator looks back over the course of the last year, and out of the last 252 trading days, which is typically what we see in a year, what is the volatility compared to? So what is the volatility right now, the implied volatility compared to those last 252 days? So right now on Facebook, looking at Facebook, we have an IV percentile of 45%. So it's about, on a scale of 0 to 100, 100 being the very highest volatility that we've had over the last 252 days, and 0 meaning the lowest volatility. Right now we have a score of about 45. And so if we're going to be selling options, we definitely want to be selling on the upper half of that, so 50% and above, or sometimes even higher. If we're buying options, typically what I want is below 33%. So you can see right now it's kind of in no man's land. This is not really a great time to be buying options because we're still paying a little bit too much for them. And it's an okay time to be selling options, but there are better times to sell options than 45 percentile. So you always hear this expression when it comes to trading, let the trade come to you. This is a great example where you don't want to be doing selling of options if you don't have anything to sell. And this is a great way to understand where it compares versus what we've seen over the last year. Conversely, we don't want to be buying options when this value is too high. So waiting for this value to come down before we start to buy options is probably a wise tactic. That's it for today's Market Minute. Thanks for listening, folks. We'll see you tomorrow.